All right, everybody, we are live. So excited to see you guys coming in. I know right now there's some of you popping in, whether you're coming from YouTube or StreamYard. I think we even have you connected to LinkedIn right now. So excited to see you guys. I know some of you already started to say hi. Go ahead, say hi in the chat. Tell us where you're from. I see we got John from Orlando. We've got Jeff from Salt Lake City. We got Ralph, who's busy with patients and he's hoping to listen to the recording later. We got Roberto from out in the Northeast. So we've got pretty much from sea to shining sea. We even got the Midwest represented as well. We can see some Iowa as well. So excited to see you guys here today. I wanted to go into really what is at the heart, I think, of many people, which is what the heck is going on right now? And what do we need to do about it? Should we be doing anything? Should I just sit tight and just ride these waves? Or is there something we could do that's more proactive that makes it better? So Bob, you from Phoenix, you were in the right place, man, because that's exactly what we're going to talk about right now. Okay. All right. So without further ado, I'm jumping right in here. So if you haven't figured this out, that's me. I'm the guy here that's doing this. But I really want to talk about how do we protect our wealth and profit from this recession right now? So one is how do we protect our money? But then two is how do we make sure we make a lot of money? Because a recession, and I really do truly believe we're moving to recession, really have been in a recession, yet it's been masked by a lot of over government spending and things like that, that as a result, people are thinking we're in a good place, but we may not be as good as we thought. But recessions are also one of the best times to make a lot of money. And I'll kind of go into what that means for here. So the big thing is, what if I can show you how to do this? You can massively grow your wealth without a lot of time. You don't need millions of dollars and you don't need a lot of financial training. And by the way, it's not just me. Hundreds of my clients have done this, and I've over the last almost 2 decades now. Okay, so this is what I want to talk about: is how do we grow our wealth? Now, I also want to emphasize again, we're trying to protect the money too, right? Because the one thing that could be absolutely just devastating to you is, what if you were to lose half of your money right now? What if the market dropped like a rock? You were too afraid to act, and then all of a sudden you've now got half your money. What are you going to do? Now, if you did like what most Americans would do, you would hang tight. You would just ride that roller coaster down, hoping the roller coaster goes back up to where you were before, if not higher. But just so you know, when the stock market drops, it drops fast and recovers slow. And so if you're the average American, you're going to be the one holding on to that ride and hoping and praying it's going to work out for you, right? I don't believe in hope and pray. I don't believe in smoking hopium. I believe that we can actually do something with action. And right now, you got a very critical time. You are on the cutting edge, the leading edge of something great, because the stock market has not reflected a complete recession yet. But when it does, and it always does at some point, and I believe that time is now, then you're going to find lots of people losing money, lots of people freaking out. And I want to prevent the freak out. And so I want to talk about the state of the economy today, where you can actually keep your cash and keep it safe, and what are some recession resistant I can't even say that. Can't even say that one time fast, not let alone 10 times fast. Recession resistant investments that you may not even know about. So we'll talk about those, all three of those things today. So you're aware, as a bonus here on this one, we're going to offer a free consult. Often we'll talk about different things we've offered in the past. Here, let's just have a conversation, right? But before you even worry about that conversation, let's just dive into really what this is about. Now, I know some of you guys have been on here before. You know, I know like Ralph, I've definitely seen you on this on our masterclass before and things like that. But I really want to emphasize the story behind my dad, right? Because this time that we're in right now is exactly what I was experiencing then with him. I understand that I became a financial advisor. I wasn't intending to become a financial advisor initially. I was actually going to become a business consultant, but I wanted to start some business to learn how to do business and then become a better business consultant. I wanted real life experience. But as I became a financial advisor and learning about money and investing, I got pretty excited. I thought, worst case, I learned about money for myself. Best case, not only does it help me, but maybe I can help some other people too. And maybe it can help my dad, who is like the strict penny pinching saver, the guy that was like this so cheap, you know, was just a tightwad growing up and was just slaving and saving away, right? This guy was just working his tail off to the point he had heart attacks and strokes by the time he was in his 40s and 50s. He believed his job would literally kill him from the stress. I wanted to be able to give him some of his life back. So after I was a financial advisor for 4 years and I was drinking the Kool-Aid, I was on that same path. I was being cheap like my dad was, saving everything I could, slaving away, working even overtime hours to try to make try to not just make money and take care of my family, but even have more money to save so that I could be in a better position and maybe I'll be able to retire in my 40s based on my calculations and my little financial advisor calculator. I was on that same path. When my dad reached out, he said, Chris, I'm 61. I want to retire now. So meet with me, please. Like, let's help me out. So I sit down with him. I look at his numbers for the first time in my entire life. He would never share that because he was so afraid of people stealing or taking advantage of him or something like that. So I'm looking at his full finances. He was very open and honest with me. He was getting desperate. He says, Chris, what do I do? And I see that he had paid off all of his debt, including his house. He paid off his house in 18 years. So he paid it off early, 100% debt free. The guy had stuffed money in his 401k, getting the match, doing everything that maybe you've been taught to do as well. And the same thing I always teach people to do too. And when I looked at all those numbers, I said, Dad, if you want to retire right now, you're going to run out of money in about 5 or 6 years. You're going to need to die in about 6 years so that you don't run out of money too soon. Because the truth is, you just don't have enough. Okay, well, what do I do, Chris? I don't know. Like, you can't cash money out of your house and put it in the stock market. That's actually illegal to put it in mutual funds that way. I can't tell you to do that. Plus, my conscience wouldn't allow me to do that because what if the market tanks? Which, by the way, 2 years later, it did. What will happen here? And so I just told him, I said, Dad, I don't know. Just keep working. And so my dad literally worked into his 70s. This bothered me so badly because I knew there had to be something better. 2 weeks later, I'm talking with a friend. Ironically, they talk about how when the student's ready, the teacher appears. What I didn't expect is that the teacher was actually my student. It was a guy I trained to be a financial advisor. He then quit and he went to do something called real estate investing. You guys might have heard of it. If you've seen my stuff, you've heard of it for sure. But he was doing real estate investing, more active real estate, like fix and flips and things like that. And I call him up. I was like, hey, man, how are things going? He's like, man, my life's amazing. My dad and I have partnered on some real estate deals, and we've now doubled his income as a professor at the university here. I said, wait a minute. You've been doing this for 5 months. How is that even possible? That's too good to be true. No way is that possible. He said, Chris, well, tell me this. You think you're so awesome, right? You think you're so great. Because I was telling him that, no way, stocks are better, real estate sucks. He says, well, Chris, how many of your clients are really financially free where they're not worrying about money? Well, none. They all worry about money. Great. Good job, Chris. How about this? How many of you guys as financial advisors are financially free, not off the commissions, but actually doing these investments you've been telling your clients to do? And he knew the answer to this because he was working in that same office. There's 100 of us or so. And I said, none. I think because there's guys working here since the 1970s. These are guys like in their 60s and 70s still working as financial advisors because they can't retire either. There's your problem, Chris. And that's what got me down this path, right? That's when I started to take that matrix red pill. I started to see and be open to all these alternative investments in this other way of doing money, not the typical just pay off your debt, and stuff your money in your 401k and in stock market, mutual funds, everything else. And then someday it's just going to work out great. That's not the reality, guys. It's a good dream. It sells really well. And so many people teach it that people believe it. But unfortunately, the reality is not that way. And it's even worse when you move into recession because guess what? My dad, part of the reason that he was having an issue is because he had just come out of a recession. Y2K had happened. The market was going back up. It started to recover a lot of those losses, but Y2K set him back. He was hoping back in 1999, he was thinking, man, if things keep going this way in the stock market, maybe I'll be able to retire by the time I'm 60. And so he was just seeing up, up and away. But when the market corrected, and it did that over a course of about 2 years, and then it started to finally, after 2.5 years, really, then started to bounce back up. It finally took till 2007 to finally get back to where it was in the year 2000. But then it tanked again into the next Great Recession. Every time he thought he was about to finally hit that freedom, it was taken away from him. That is just stupid, isn't it? Doesn't that seem almost criminal if you really think about it? Not to mention, by the way, the financial advisors got paid the whole way. And so when I started to go down this other path, looking at alternative investments, later the next year in 2006, I was able to retire at 28 years old by doing the very things we're going to talk about today. And so, but again, the problem is just this, guys. If you don't have cash flow month after month, and I know it's getting worse because we got inflation kicking our butts. It's obviously putting stress on our families. Not to mention, by the way, we create a legacy of stress when it comes to money about this, right? We've got, like I mentioned, inflation is going crazy, but we know inflation is way more than 2% like they claim. We got interest rates that aren't coming down as fast as people thought. You remember what people were saying back in 2024? Oh, the rates will come right back down. We'll see 3% mortgage rates again. BS, right? We got the national debt going sky high right now, adding trillions every few months, right? We've got, of course, the fact that the government's got to worry what to do about taxes because the Trump tax plan is about to end this year. One of the lowest tax rates we've had in the last 110 years since the federal tax rate, and it's about to come to an end and reset and go up higher. If they don't forget about tariffs, guys, like taxes is going to be the next issue. That's the thing. Everybody's worried about the stock market and the tariffs. Well, once they resolve that, and I think it'll get resolved in the next few months, they're going to move right over to, hey, what about Social Security? What about taxes? Like all these things are blowing up right now and they haven't even been addressed. All this stuff is starting to happen. We got stocks have been way too freaking high. This is called the Buffett indicator, Warren Buffett indicator, saying what's the stock market value compared to the gross domestic product, the health of the economy. Right now, we're over 200% of what it is. And even after it's corrected, guys, it's still about 180% of where it should be. That means stocks are about double the value of where they should be right now. They're out of whack. And not to mention this red line right here, if you see on this chart, this is a trend line. I used to be a stock trader. This is the long-term trend line of the stock market since back in the 1920s. Notice that it's way higher right now, way higher than it should be. Way higher. Remember the last time it corrected was the last recession. What if that starts to come down again? What if that starts to pull back and you literally, if you're in the stock market, lose half your money? Buffett, by the way, has already been liquidating all of his stocks. He's sold off Bank of America and Apple stocks. Huge positions he sold off in those companies already back in 2024. He's now got 25% of his money in just cash, $334.8 billion as of last month. Waiting for the updated number to come out soon. But guys, he's been holding on to cash, and that it's just gone up hundreds of billions literally in the last year. And you got people out there telling you just live on rice and beans. That's how you get through a recession, right? Just get cheaper. And yeah, that works to a degree, but at what cost? By the way, that same guy that gives you that advice to live on rice and beans, he's also the same one that tells you save $100 a month for 40 years and you'll have over $1 million. No one should retire broke. However, two problems. One, he can't do math because he's about $200,000 off if you put that 12% a year that he was claiming into a calculator. He doesn't get that number right. And worse, look at this, guys. Like this woman right here, Michelle, 1A, whatever. She's like, I follow your advice since I was 18 years old. Now I'm 50. So 32 years later, she's like, I've lost my retirement in the stock market. I've done what you said. I've lost almost all of it. Is there anything else you recommend? She's going right back to it. She's asking for advice from the very guy that gave her bad advice in the first place. And there are so many freaking lies out there. They're telling you the market's 12%. Guess what? I taught that. I believed that. But then I started questioning it because when I looked at the real numbers, looking at the actual S&P 500, guess what the real average is, guys? 8.03%. Now, that might be a little bit higher as of today in the stock market. It might be about 8.07%, but it's just over 8%, guys. 30-year average, just over 8% in the S&P 500. We've been telling people 12. That's a big deal because remember that 12% I said that Dave Ramsey showed you, right? You're going to have almost $1 million saving $100 a month. What if you only earn 3% less? What if you, instead of earning 12, you only earn 9? 424,000. You have less than half. 3 simple percent means it's less than half. That's a big, big problem. That's a massive overpromise, underdeliver, isn't it? By the way, I got to take a breather right here because I'm just ranting. Are you guys with me at this point? Anybody else pissed off about this so far? Put that in the chat. By the way, if you put it in the chat, I'll see it about a minute later. So I'll see it in a bit. But let me just keep going on because inflation, we've been told inflation is like 2 or 3%. I used to teach as a financial advisor. And in fact, I used to tell people, yeah, you know what? 2%, 3%, I put 3% in my calculators, but it would depress people. So I put in 2% as inflation, and then people would feel like there's hope for an actual good retirement, like a comfortable retirement. No, that's not it, guys. That doesn't work. Okay. It's not 2%. By the way, with tariffs, everybody's worried about whether it's going to happen with inflation. Yeah, it could definitely be affecting things. People are already counting on it. By the way, the numbers just came out today. Retail sales were up last month in the month of March. They're saying, hey, look, retail sales are up. But a lot of them are saying, yeah, but they're up because everybody's scared about tariffs and extra costs. So people are starting to spend a lot more money, including people are spending money that they don't have in fear that prices are going to go up, just like they saw egg prices skyrocket a few months ago, right? So people are freaking out about that. Just so you know, the real inflation rate is roughly about 7% higher. This little chart here comes from shadowstats.com. You look at that, you'll realize that the actual inflation rate, based on how they used to measure inflation, but then almost every presidential administration has messed with the numbers to make it look lower. So then they don't have to pay as much into Social Security. So then Social Security lasts longer. It's about 7% higher. So if they say 2%, you're really seeing a 9%. By the way, they were saying like, yeah, the last 5 years only been 40% inflation. Bull. I don't know about you, but every restaurant I walk into, every grocery store I'm going into, about every person I hire to work in my yard, prices have at least doubled. Wouldn't you guys agree? So when they say 40%, bull. And house prices, that alone, come on, my house went up 50% in just 3 years when I sold it and then bought a new house. Ridiculous. Set it and forget it. This is the big one I want to focus on because this is what my dad did and it just didn't work. Okay. Set and forget it. Whenever you see the market go down, a financial advisor will tell you you should stay in it, right? Keep adding money, dollar cost average, keep putting money in. And then eventually it's okay because you're buying on sale as it goes down. Let's turn our brains on for just a minute here. Turn your brain on for a second, right? Think about this. Is there ever a bad time to invest in the stock market according to financial advisors or any financial expert out there today? Do they ever say, you know what? Now's not the time to get in the stock market? Or do they say, hey, stock market's going down, buy it on sale, right? Buy on a dip. I actually just had a podcast released on our Money Ripples podcast. If you're following our YouTube channel, do so if you haven't. But I talk about buying the dip and the fallacy behind that and dollar cost averaging. I even showed this little sheet here that I showed clients when I was a financial advisor saying, hey, you want the Great Depression because that's when you buy everything on sale. If I were really a smart financial advisor, wouldn't I just tell people, wait till the market crashes, then get in? Because guess what? The stock market, as it keeps going up, it's getting more expensive when it goes up. They never told you to stop buying when it was going up, did they? They said, no. You can't time the market. You don't know when it is going to be. Just buy at all time. What a perfect little sales strategy for a financial advisor to tell you always buy, isn't it? And I'm calling it, I hope you don't mind if I'm calling it as it is, but I am, okay? I'm calling it as I see it because I taught this, right? I bought into this hook, line, and sinker. I believed it for myself, only to realize I was telling a lie, okay? So that whole set it, forget it, you're in it for the long haul. The problem is this, it was when the market goes down, they'll tell you it's okay. You're in it for the long haul. Just keep putting money in. Well, if you're about to turn 60 years old, or maybe you are 60 years old, and the market drops in half, how long is that long haul going to be? Think about my dad. The market did drop after it did recover a little bit in 2007. He was starting to have a little bit of hope. And then bam, the market collapses again, all the way from really the beginning of 2000, really end of 2007, beginning of 2008 till March of 2009. The market lost 40% of its value in just about 15 or 16 months. That's all it took. But the recovery took another 4 years to get back to where it was. So it drops like a rock in like I said, 15 months or so, but it takes 4 years to recover. But here's the problem, guys, because they're being charged in fees all along the way. Most people I talked to in 2013, even though the market got back up to its previous high, its all-time high finally, the problem is people said, yeah, I put my money in the market in 2000. It's still not back up to where it was. Why? Because they're charging fees all along the way. So those fees are coming out. It took most of those people until about 2015 before they finally said, now I've made my money back. 2000, 2015, 15 years, 15 freaking years. Just so you know, by the way, this is as of November. I think these numbers are going to be lower now. They were guessing that the market would only do about 2.8 to 4.8% average over the next 10 years. That's like 3 to 5% maybe. I bet you that number is now lowered. I bet you it's more like 3 or 4% average over the next 10 years. Do you realize you could probably make more money in a bank CD than you would letting it stay in the stock market in the next 10 years? Now, Vanguard and other companies, they've been wrong before. They could be wrong again. It could go higher, but it could also go lower. From 2000 to 2010, the market went down. Now, they'll always say, well, over 15, 20 years, you're in for the long haul. It doesn't matter because, market always recovers. It always goes up. It does. But if you're at the end, the tail end, if you're like a Gen Xer like myself, you don't want to be in that place, do you? Because that long haul, you never know. By the way, here's the stock market. Notice that high in 2000? Right there, 2007, it finally hits that high. People are feeling hopeful and then crash down fast, comes back up. Like I said, 2013 is when it hit there, but it was really about 2015 when people said, now I've got my money back. But again, because of inflation, people are like, oh, I didn't really make my money back. The balance shows the same, but now my buying power of my dollar is less. So that means really it took me till about 2020 before I finally said, now I finally caught up with inflation. Now I made my money back. You may not have that long. You may not want to wait that long. Here's the 4% rule. They keep telling you, oh, it's okay. You live on 4%. Do you realize that 4% rule came from a study from 1926 to 1976? That study is about 50 years old. And they were basing it on life expectancy back then and inflation back then. You know that inflation is way higher now because 1974 is when Nixon took us off the gold standard. Inflation started to skyrocket after that point. The average has been much higher. So inflation is higher. And also, people are living longer. The whole 4% rule is saying, hey, if you just pull out 4% a year of your money, if you have $1 million, you pull out 40,000 a year, you should never run out of money before you're dead. They're now saying that's not the case. They're saying more it's like a 3% rule. So all those people, and by the way, if you're trying to retire early, it's a 2% rule, 2%. So again, we keep getting told all these little rules that it's going to be fine, but then people realize I don't have enough, right? By the way, people always think investing equals stocks. I just interviewed, actually, he's on here right now, but I just interviewed a guy, one of our clients, for a podcast to come out in a few weeks. And he's like, yeah, everything I knew was like, everything was in mutual funds. It was all brokerage. Investing is stocks. That's it. Going along with this next one about diversifying, right? He's like, wait a minute. I've got my money in a 401k, which is all just mutual funds, equities, stocks. And my brokerage account is also in equities and stocks, right? So you're told you diversify by diversifying among different companies. But remember, when those companies go down, they all go down. And even worse, even people say, well, I'm in the SP 500. I had somebody actually try to argue with me on YouTube saying, Chris, you know, the SP 500 is the safest, most diverse asset you can possibly buy. I was like, safest and most diverse? You realize this? The Magnificent Seven, the top 7 stocks inside the S&P 500, of those 500 companies, are 7 that really are 6 companies, because Google has 2 different stocks in this group. Those top 7 count up for a third of your stocks in the S&P 500. Are you diversified? Heck no, not even close. You're not diversified at all. This is why people are like, well, it's okay. I bought bonds with my stocks. Well, guess what? It's very common for bonds to go down when stocks go down. That happened in 2022, the only down year we've experienced since 2009. One down year. By the way, we're way overdue for having some down years. Way overdue. Everything's overinflated. We got this everything bubble. That is a big deal. And of course, everybody's going to say, well, the 401k is going to be fine. And it's okay because I got that free match, right? I get that free money. Now, if you're a business owner and you're paying your own match, that's not free money. You're still spending money for that. It's ridiculous for you to even have a 401k, not to mention all the extra costs and fees you have to pay on that sucker. Admin fees. It's just ridiculous to have those plans. You only do it because you think that's what every employee wants. By the way, I've had business owners cancel the 401ks and say, you know what? We're just giving everybody a raise of 3%. You know, the match I would have paid you, just take this raise and you do whatever you want with the money. You can go invest in this or that or the other, or you pay off debt, do whatever you want. Well, here's the thing, guys. 401ks do have massive fees and they underperform the stock market. Fidelity, to give you a good example, Fidelity, their target date retirement funds, I actually went and looked at their 10-year history because they haven't been around that long. So I looked at a 10-year history. They underperformed the stock market by 2.1%. What does that mean? That means like the market average at that time of roughly about 10%, but unfortunately, it only did about 8% over that 10-year period. Now, that does not include the fees that come out because 401ks have the worst fees of anything you invest in. And so there was at least a 0.75% just base fee for those Fidelity fees. That's not including any other fees that might get charged in addition to that. That means you underperform by 3%. Well, what happens is this. Yeah, actually, I'll show you this in a second. Wait, is it here? Oh, nope, I took it out. Here's the thing, guys. It might have came up later. Maybe I took it out. Here's the thing. If you invest in the SP 500 just without all those extra fees versus a 401k with a 100% match, that 3% difference that you make in the market versus that 401k, that target date retirement fund, guess what? All that 100% match did was make up for the bad performance. So you look at the two together, you'll actually still make more money investing by yourself than we will put money on a 401k with a 100% match. This is one reason why people are so stuck with their 401ks and realizing, wait a minute, this isn't enough. And they have to keep doing other things to be able to do it. They have to keep throwing good money after bad to do this. Just so you know, if you don't believe me, look at the statistics. Fidelity's got about 46 million account holders, only 900,000. And this is as of 2024. I'm sure that number's gone down, so the market's come down since then. But there was 900,000 have at least $1 million. That's about 2% have $1 million or more. Now, of that 2%, of that 900,000, Transamerica did a separate poll, said, hey, how do you feel about your retirement? 35%, over a third said it will take a miracle to retire because they realize that 3% rule, right? Like, wait, if I have $1 million, 30,000 a year, I can't live on that. That's not enough. I got to have at least 2 million, 3 million to live even just a basic middle class lifestyle. That's the problem. Average Gen Xer that's been saving for at least 15 years has about 599,000 as of 2024. Again, that number could be a little worse. Now, if you're an Xer, remember, if saving at least 15 years, let's just say you're 50, 55 years old right now. What would happen if all of a sudden that 600,000 became 300,000? How long are you going to be in that long haul for? Oh, yeah, there's a 401k reality, right? The truth behind it. Can't really see it. My thing got a little messed up on the font, but basically, you invest in the stock market, you have about the same as if you did a 401k. The right one was a 401k, left one's the other one. So let's get down to the answers here, right? I love what Jerry Seinfeld says, in the episode Opposite George. If you guys ever watched Seinfeld, George Costanza, as you know, is kind of a loser, right? But for one episode, he became a winner because Jerry said this to him. He said, listen, if every instinct you have is wrong, then the opposite would have to be right. And so George, for that episode, said, all right, I'm going to order I'm not going to order the same food. I'm going to order a different food. And then what happens? He decides he's going to talk to a beautiful woman. He ends up getting the woman of his dreams. He has different food. So he actually has some variety in life. He even lands his dream job working for the New York Yankees, right? He gets all this stuff because he did the opposite. What if everybody, like we've already seen, like there's less than a 2% success rate with using 401ks and everything. What if we were to do the opposite? What if we were to do something different? What if we actually did something that already tens of millions of Americans are doing right now? But again, because they're not paid like financial advisors, you're not hearing about it. Because the truth is, Fidelity has got billions of dollars to market to you. They buy out the media, the financial media, they buy out everything, right? The media is not going to bad talk Goldman Sachs because they pay the bills on their advertisements. That's what you're dealing with. You're dealing with all that money being out there thrust at you. And they have their little peons like myself, what I used to be as a financial advisor out there, just really perpetrating all these lies, right? And yet who suffers? Not the financial advisor, although their retirement accounts don't look great, but they still make lots of money off of you, keeping your money with them for the long haul, don't they? So this is where it comes in. Cash flow is what creates freedom. It's not about how much money you have in your retirement accounts. It's about what kind of income are you getting each and every month that's coming to pay for you, your family, your bills, and your life, even your lifestyle. Cash flow is what creates freedom. I love what Warren Buffett has to say here. He says, if you don't find a way to make money while you sleep, you will work until you die. Sadly, there are tens of millions, if not hundreds of millions of Americans that already know this to be true. The problem is this. Most people will blame you for this. They'll say, oh no, you just didn't save enough. Or no, you had debt. Or no, you were trying to pay for kids' college. Oh no, you did this or you did that. And then their little calculators, life looks perfect. But your life was never meant to be put in a calculator. Your life was meant to be doing something better than that now. So here's the system. Here's the process that's been proven to work time and time again. Number one, you got to shift your perspective, right? I'll tell you this, and I actually said this on an interview with another podcast I was on today. The hardest thing for all of our clients, for them to actually be able to find freedom, is they got to shift their perspective. They got to break away and break free from believing the traditional slave and save mentality, right? That you got to accumulate your money. You got to save it up for that, like a squirrel saving all those nuts for the winter of retirement, hoping that winter doesn't last too long to where you run out of nuts and starve to death, right? That's what they've been trying to teach you. And of course, they sell you everything. It's like, it's going to be wonderful. And look at this little pamphlet brochure. It's got this couple with a full head of white hair sitting on a beach, enjoying life with a little sun hat and everything. I know because I had that flyer that I passed out to people. They give you that kind of stuff. They paint you this beautiful picture, but in reality, people are living on fixed incomes, right? And so you got to shift that perspective away. You got to start looking at money differently. You got to look at cash flow, not accumulation. Income, not just interest. You compound income, not your compounding your interest, right? That's the key. So shifting that perspective, then of course, where can you keep your money safe? Max ROI Infinite Banking is one of those strategies we're going to talk about here in a little bit, just for a few minutes. It's not the main focus, but it is a great place to store money if you want to keep money safe, risk-free, without worrying about what the recession is going to do. In fact, it's the only thing that's resisted every recession and made money consistently. And then, of course, passive investments, right? How do we create passive income, not just trying to accumulate and hope and pray that at some point we're going to have enough to live on when we try to live on less than the interest. Passive income is the key. And as you have that passive income coming in, again, keep rotating that through as you move your money around, again, compounding that income that comes in to then reinvest again and again. Let me go deeper. Here's the thing I told people in 2020 when I thought, because 2019, just so you know, 2019, we were all calling for a recession. It was all the indicators were actually screaming a recession's here to come. Then, of course, what happens in March 2020, you all remember. If you're at least 5 years old, you remember. And I'd imagine there's no 5-year-olds on this or 4-year-olds listening to this right now. But you remember March 2020, we had the COVID outbreak, right? And we started to see this market plummet. But, we had guys like Trump and everybody else going to emergency mode. They say, okay, we cannot let this happen. What are we going to do? So, of course, what they start doing? They start printing more money, didn't they? Printing it like crazy. And they start throwing it at you left and right. We had like all the money coming back and extra tax incentives and things like that. And hey, you know what? You can delay, doing this. And by the way, you can pull money out of the stock market. You can actually pull out your IRAs right now, $100,000 you can pull out. And guess what? You could pay back taxes over the next 3 years and have no penalty on it. So we were able to pull out 100 grand from our IRAs and 401ks penalty free and just pay taxes over 3 years to soften that out. We had EIDL and PPP loans, if you remember all those, right? Business owners were said, here, more money, just keep your doors open, keep people employed. They were throwing money out left and right, all over the place, causing a massive, massive bubble. And as they always say, when you have a greater party, there's a greater hangover. So when we were supposed to move into recession, they literally pumped money into the economy to essentially delay the recession till a later date. And so now we created this massive bubble, especially in the stock market. And now we're finally at the point where people are saying, hey, I don't even care if tariffs are done. You notice the stock market hasn't rebounded, right? It's still sitting there. It's still sitting lower than it was, about as low as it was about a year ago. It's just sitting there right now, waiting for any kind of good news, but even good news coming out still doesn't do much. That's a massive headwind because if there's any bad news, as the wise, 90s band would say, baby, bye, 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 right? Like that's gone. That's what's going to happen. Okay. So here's what you do to get out. This is what I said in 2020, and it definitely applies today is get lean, get liquid, get out. Get lean, right? This does not mean just live on rice and beans, but it does mean you need to start tracking your money. Start to see where you can cut some excess, things that maybe aren't doing you any good anyways. Maybe you got subscriptions that you're paying for that maybe you shouldn't be paying for anymore. Maybe they're not doing you any good, right? Maybe you're paying for things that really you're just eating out way too much, right? What if we could start coming home, even though the groceries are going up in cost too, still making food from home and doing things like that to help save on costs? What if you start saying, you know what, let's just cut out all the extra busyness in our lives, maybe focus on things that are most important. Get lean, make sure you've got profit. This is something that's worked every single time in every recession and even depressions, especially if you get lean proactively, not based on need, but based on preparation. Now is the time to get lean. Get liquid. Get liquid means that you now have cash available. And then get out is once you have that cash liquid and free, especially when you move in a recession and people don't have money, then you get that money out. And that person that has the cash controls the game. Let me talk about an example. Back in the Great Depression, you might recognize the guy, especially on the right hand. The guy on the right hand side here, young kid. But that guy's John F. Kennedy. In the middle is Joseph Kennedy, his father. Now, Joseph Kennedy, there's always like these rumors about him being a bootlegger and things like that. But Joseph Kennedy was more of a stock trader. And in 1929, he was worth $4 million, which was a significant amount of money back then. Now, he was worth $4 million. What's shocking, though, is by 1935, he was worth about $100 million. He went from $4 million, about $100 million during one of the worst economic periods of our entire country's history. He actually prospered during that time and didn't actually go broke. He did the opposite. How did he do it? I'll tell you. 1, he got lean. 2, he got liquid. And then 3, he got out. Literally. To tell you what I mean by that, he did start to pare down some things, but what he did is he got in preparation. He started getting liquid. He started moving his money away from the stock market before it crashed. Now, some people wonder if it was insider trading or whatnot. It's hard to say, right? He could have. The rumor was that he was talking to a shoe shine boy And he said, "Hey, what is everybody talking about investing in right now?" And he's like, "Oh, everybody should be buying this in the stock market." And that's when Joseph Kennedy said, "I need to get out of the stock market." That's the story has been told. It's all myth and fable, but either way, he got his money out of the market before it crashed. He pulled his money out. Now, as it started to crash, he was still liquid with cash. But then what did he do? He went and bought up dirt cheap real estate in New York City. He bought up tons of commercial buildings that were on a fire sale, bought tons of them. And by 1935, even though we were still, struggling financially, even at that time, we didn't see much of a change through most of the 1930s, but it started to recover a little bit. His value with all that property he bought a discount because he was the one that had cash. Well, most people didn't, and it was deflation. It wasn't even inflation; it was deflation. Then he was able to buy it for dirt cheap, and then as it came back, as inflation started to come back again, he was now worth over 100 million. He bought real assets, and he bought them cheap. That is one of the biggest keys. If you got nothing else, just learn from that story, because what I'm going to now, the details, is really what that's about. So getting liquid, right? How do you get liquid? There are various places you can get your money out of. Bank savings, obviously, right? You've got money in savings. That's a liquid place. Now, I would not 100% count on banks, because the problem with banks is that if banks go under stress, FDIC can only reimburse 1.5% of all bank savings out there today. So if we ever have more bank failures, like we saw even in 2008, but especially like even a few years ago, we saw a Signature Bank, right? And banks like that. If we saw that happen again, and then all of a sudden everybody's running to the bank to get their cash out, you know what's going to happen? It won't be there. You'll have to wait for the government, just like we had to wait in 2020 for the government to create the PPP and EIDL loans. And banks are like, we're ready to go. And the government's like, we're not. We got to make more fake money to do it. They didn't have the money in time for a lot of businesses that did end up failing in 2020, right? So bank savings, although it has a place to get it, that may not be the safest place. There's life insurance cash value. The cash value of life insurance is the tax-free savings account inside of life insurance. I find so many clients, even now, they're saying, wait a minute, I didn't realize I could use that cash. I was always taught to use that for my retirement. Yeah, you could use it for that. But what if you could use it now to create passive income today? That's a different story. Mutual funds, right? If you got brokerage accounts, mutual funds, things like that, you could liquidate those. Old 401ks and IRAs. If you're currently working for a company, unless you're 60 years old, you probably can't tap into your 401k at work. But if you got old 401ks, or you have other IRAs, Roth IRAs, things like that, that's money that can be used. And by the way, did you know you can roll over into what's called a self-directed IRA and use that money to invest? We have rental properties. See, some people say, oh, Chris, I get the real estate thing. I've got rental properties too. Do you know one of the biggest places we find for potential that they're missing out on is the fact they have equity in these properties, yet their cash flow is not good. It's called return on equity. If you take your annual cash flow that you get, net profit from that property, divide it into the equity that's available in that property, if you were to sell it, divide it into that number and see what your return is. If it's less than about 4% a year, maybe even 5% or 6% a year, we need to be talking. There could be some things we do with that. I had one client that literally, that's what we did. He had 700,000 of equity in his property, but he's only cash flowing $200 a month. That's a 0.3% return on his equity. It took me 2 years to finally get him the faith, right? The confidence to say, I need to sell this property now, because he was so attached to it. In his mind, it was like a one-track mind, right? He was like only looking at this little narrow workhorse perspective. He's like, no, I just got to pay off my debt and pay off my mortgage on my house and pay off the mortgage on this property, and then I'll have $2,400 a month coming in. Like, yeah, that's still less than 30 grand a year on 700 grand. That's still less than a 5% return. So instead, it's like, no, cash it out, buy other properties in a better place. And he did finally, after 2 years. And guess what? He ended up making about $80,000 a year. And now, after several more years, now he's over $100,000 a year with that same 700 grand. Not, $200 a month, not even $2,400 a month, over 100 grand a year with that same equity. Home equity, again, talking about equity, home equity. Are there ways you can do that? We just had an episode come out last week where you can access your home equity without going into debt. There's ways to do that. Gold, silver, crypto. Man, again, I have gold and silver too. Somebody had just said, they're like, I bet you're going to talk about, gold's been awesome. I'm like, yeah, gold has been awesome. It's already gone up a lot. Don't expect it to keep going up a lot more, right? It's just like Bitcoin and crypto and stuff. It already had a nice run. Wait for a crash, right? If you're going to buy a ton more. But yeah, I have gold and silver. It's done great. But here's the thing. I have gold and silver as part of my wealth, like diversifying my overall plan. But that's because I'm already out of the rat race. I already have about 50,000 a month coming in passive income. So once I get to that place, it doesn't really matter. Now I'm starting to build out my portfolio in other places where I don't worry about the cash flow as much. If you're not out of the rat race, if you don't have enough passive income to be able to quit your job or your business today, then gold and silver, crypto doesn't matter because they pay nothing on the cash flow side. Nothing. So your first step is get financially independent, even get financially free. Then the second step is maybe we worry about that. But what if we could cash in your chips? Crypto, for example, great example. I mean, I did this myself just a couple years ago when it hit over 60,000 and it went down to about 50. I said, I'm cashing in. I cashed out some of my crypto because I bought it down around $6,000. It made more than almost 10x from that point. I cashed in my chips and I take that money and invested elsewhere, right? So things you could do there. That's ways to get liquid. Checking in. Are you guys getting anything from this so far? Like what are you seeing right now? Like where are ways that you're saying maybe I could get liquid and get my money working better? I'd like to hear your comments right now before I move in this next part. All right, so let's talk about infinite banking as we're talking about getting liquid because this comes up. It's funny because I had one guy say, I think I know what it's going to be. And I have some people say, you're just going to talk about infinite banking. It's a great strategy, but let me say this loud and clear. You will not become financially free with infinite banking. If you don't even know what infinite banking is, it's using whole life insurance to store cash. And then you can use that cash to invest and make more money with. You can use it to pay off debt. You can use it to buy assets, all kinds of things. But that one strategy will not, I repeat, will not make you financially free. This strategy does not work by itself. It needs these other strategies that I'm talking about here. You've got to be able to realize that. Anybody else out there trying to teach you that infinite banking is the answer is literally just trying to sell you crap. Okay. And by the way, we do infinite banking internally in our company because we couldn't find others to do it outside our company better that we could send our clients to. And sadly, even the ones that say, oh, you'll get financially free using infinite banking, we still do our infinite banking policies better than them, where you get a better return than they get. And yet we still won't say you'll become financially free. What does that tell you? If theirs is worse and they're saying it and we won't say it, forget about it. Okay. But it is an awesome strategy. And this could be one of the best places to store cash right now. Now, let me explain a little bit more about this. I mentioned it's whole life insurance. Now, whole life insurance, yes, has a death benefit. But unlike term insurance, it also has a cash value, a tax-free savings account. Just so you're aware, this is not universal life. Index universal life. There's so many people are like, oh yeah, I've got infinite banking. They taught me with this with index universal life. Does not work. Even the guy that created infinite banking, Nelson Nash, said, no, it does not work with index universal life. And the way I also know that too is even banks don't totally trust universal life, which is why they'll do limited lending, if at all, on those policies. Okay. So no, we're talking about using whole life, but specifically designed to be low cost to give you higher tax-free returns. So like I mentioned, it's tax-free now and later. Think of it like a Roth IRA, but you don't have to worry about waiting until you're 60 years old to use it, right? It does grow tax-free, comes out tax-free. You put in with after-tax dollars, but that money is tax-free and it's earning, by the way, about 6%. You'll see it's safer than the bank with guaranteed growth. By the way, banks go out of business all the time during recessions. These companies do not. In the Great Depression, in 1929, there were 35,000 banks in the United States. By 1935, there were only 13,000 left. Insurance companies, about 17 failed. Not tens of thousands, 17. Someone might argue, well, there's less insurance companies than banks. That's true. But percentage-wise, it's drastically different. And even though insurance companies did that, they still learned things from the Great Depression to become better suited for future recessions, which is why they have reinsurance companies backing them up. So even if their company that you're with would fail, reinsurance companies step in to make sure that your cash and your death benefit are protected. So that's why I say it's safer than a bank. It's been proven over the years that's the case. By the way, I use companies that literally have been paying people for the last 175 plus years straight, not just the minimum guarantee, but above their guarantee. So that's one big thing, right? There's no limits or penalties, right? I don't have to worry about 59 and a half rules. I could literally retire younger using this strategy along with the other investments I'm doing, like in real estate. Protected from lawsuits and creditors. In most states, 100% of your money is protected in here. That means you can have millions of dollars here. No one can get to it. No one. You can't say that about a bank savings account. Bank savings accounts, by the way, if you lose a lawsuit, bam, they got that money right out of that savings account. They can get it. They can put a lien on your house. They can do all kinds of things. But your life insurance cash is protected. This is why I have so many friends So many friends that are in the real estate space will store millions of dollars. They won't even invest with it. They'll just let it sit there as their liquid reserves. By the way, many of them are also storing money there because they know with a recession coming, they want to be liquid with cash. So then they could be like Joseph Kennedy and buy up a lot. I also mentioned, of course, protects your family and your legacy, especially with that death benefit. And of course, most importantly, you have access to cash today. You don't have to wait years and years or till retirement to access this money. It's not like a 401k where it's locked away and you literally cannot get to it unless you quit or get fired from your job. Not a recommendation, but here the money is accessible even day one, especially with how we design them. So it's a great place to store cash, earn better than point nothing percent at your bank, and it's tax free. So downsides of this, of course, is that in the first few years, you've got insurance costs coming out. It's not like a pure savings account where no costs are coming out. There are costs coming out, especially in those first couple of years. That's why we had to minimize the costs as much as possible. And then we had to go even lower than all those other guys out there talking about infinite banking, because we want to make sure it made sense for me, even myself, in my own personal situation as an investor. Otherwise, I wouldn't use it. I would just use banks, right? But I use this money all the time to store cash. In fact, I keep most of my money here that's liquid and some of my money in the local banks. But usually the money that's in my banks, that's the money I'm using to invest really quickly. I'm storing up more cash to be prepared to have that money available so that when people don't have the cash going into recession, I do. And those that have the gold make the rules. That's why it's a big thing. On another side note, I just talked to somebody who's 72 years old, dentist, a retired dentist. And he said, man, Chris, I went all in investing, but I wish I would have kept more money liquid doing this. He's like, especially if you're going to take higher, sometimes higher risk, depending on what you're doing with your money. If you're in the stock market, it's good to have money, is guaranteed to not lose. And it's always going to be there to protect you and your family, and maybe even give you some extra cash to be able to make more money with it. So remember, don't compound income, compound your income. Let's say this in reverse. Compound your income, not your interest. Okay. Now, stocks versus real estate. I know this is always a debate. I want to go into now the investing piece, the passive income side, right? Everybody always talks about the stock market being best. I said the same thing. I said, yeah, real estate just keeps up with inflation, which is true based on house prices. But that's not where you make the biggest amount of your money in your real estate, right? That's the thing that I didn't realize. Give you an example, May 2018. So now almost exactly 7 years ago, I bought a house in Tennessee, right? And I keep tracking on this thing. Now I put a $32,000 down payment. Now I'm showing here on the left-hand side here, the stock market, same period of time, average about 9.65% as of about last week. Okay. So the market still did really well, better than average over the last 7 years. I also have my real estate too. Which one would have done better with that money? Because if I put 32,000 in the stock market, I would have 61,000 today if it was in the S&P 500. Not bad. Doubling your money in about 7 years, pretty good. Now, with my real estate property, I actually earned 159,000 between cash flow, debt pay down because my renters pay down my mortgage for me, and appreciation. Now, let me ask you this. Would you rather have 61,000 or 159,000, right? By the way, I lowered that number just to be conservative on the appreciation part. That's a huge difference. Now, here's the better difference. Cash flow wise, what am I earning cash flow net after I pay my property manager? Because I don't manage the property. I literally have never seen this face to face, but I'm getting paid on it. But however, if I would have put that money in the market, 61,000 at 3% means you pull out 1,800 bucks a year. I'm getting paid net 8,300 bucks a year just from that 32 grand. And by the way, that's tax advantaged. Where I wouldn't get that in the stock market, I get tax advantages where I pay little to no tax on that 8,300 a year. So I get to keep more of that versus paying tax on 1,800 a year. Which one's better? Exactly, right? Okay, what are those investments? And I'm going to talk about all these investments, but I want to talk to you about the ones that tend to be more recession resistant, as I promised earlier. One, I just mentioned like what I was showing you, turnkey rentals, right? Turnkey rentals is not like buying a rental in your backyard and then you deal with the tenants, the toilets, and the trash. A turnkey rental is where you actually go to a turnkey real estate company. They have a portfolio of properties. Now, they will either be very specific to a certain region, like a certain market or a certain location, geographic location, like a city like St. Louis, for example, right? Or maybe it's Indianapolis, or maybe it's Memphis, Tennessee, or wherever it might be. That's why some companies are called Memphis Invest, right? You got these turnkey companies. Now, they'll have a whole portfolio of properties that you could buy, and they'll even have a projection of what they believe the rent will go for. Now, of course, rent can be more or less than what they say. Depending on what your mortgage rates are, the numbers can be different. But the cool thing is, you can literally know how much money you're going to make upfront, right? You can know about what amount of cash flow you're going to make per month, not even counting appreciation. And by the way, I will tell you this, don't count on appreciation. But turnkey rental is probably one of the safest places to store your money. Safest places to not just store money, but also earn money from. Now, lately, it hasn't been great. But I will tell you this, if you were worried, if you were to try to pick one thing to do real estate wise, that would be the safest, not risk free, because none of these are risk free. And anybody who tells you is lying. But if you're looking for the safest, turnkey rentals is probably the thing. It may not make you a lot of cash flow right now because, again, higher interest rates, the rents haven't quite caught up to that. But the nice thing is, just like with my rental, again, every year, as they keep renewing the leases, they keep raising the rent, right? And you make a little bit more every time. So you actually see this inflation hedge on your income that you're receiving. And of course, you get appreciation, which also is inflation hedge. And the cool thing is, because I put a 20% down payment, any appreciation I get is like a 5x factor. Because if you put 20% down, let's say it was a 20% down on a $100,000 house, right? That's 20,000 bucks. Well, if that house appreciates 10%, that means it goes from 100,000 to 110,000. And you'll say, well, it's 10%. No, because all I put was $20,000 down. It appreciates $10,000. That means I made 50%, 5 times. So if you're looking to grow your wealth, real estate property is one of the easiest and most certain ways to do it. Is it guaranteed? No. Could you buy a lemon? Possibly. And there are ways to ask questions and do things to minimize your risk to do that. So that's the one I would say, recession wise, is probably one of the most resistant, but also probably one of the safer ones you could look at. The next one, this one's been more popular, is lending, right? You can actually lend your money to real estate investors. You don't have to be the one borrowing money necessarily to go do real estate. You can be the one lending the money. Now, just so you know, all these passive investments are all based on you having cash. If you don't have cash, passive income is not happening, right? I will just tell you this first and foremost upfront. You got to exchange something. If you're not exchanging time and energy, then you're exchanging money. If you don't have the money, you exchange time and energy, right? Now, in this case, again, because I have the cash, I know I'd rather use my cash to go with those people that are putting in the time and energy. Lending is a great way. There's a lot of people out there trying to flip real estate properties. They're still making great money out there right now. They want to borrow that money, and let's say they borrow $200,000 from you, but the house is worth $300,000. They might say, "Hey, I'll agree to pay you 10% a year on this money to be returned in 12 months." Now, what if they don't pay you your money? What if they don't return that money in 12 months? Well, because you could be on title, just like a mortgage company is on your title when you have a mortgage. If they're not paying you, you have the option to foreclose on them. Not ideal, right? We don't want to have to go through that hassle, but that's one thing. Now, understand that these guys that are flippers, they don't want to have to lose out on this too, because if they know, especially if they put their own money in and they know that you put 200,000 in, they want to get all that equity. If they know they can sell for 300,000, they want to make the 100 grand. But if they don't, if they don't pay you, if something goes wrong, at least you have a property with equity, just like a bank would when they repossess a house. Same thing you can do as well. There's also funds that do that too. That's the third one there. And there's even lending funds or different types of funds invest in different things. Could be in different types of real estate, even diversified in different types of real estate. Sometimes they're just lending funds. I interviewed somebody recently where they're like, "Yeah, I'm getting paid 1% a month, by literally not just being in one lending deal, but many, I have a certain ownership in many lending deals. And I'm lending my money to that company to then lend out to others, right?" So lots of things you can do. Again, not risk-free, but it's so awesome. This is the first thing that I learned when I started looking at real estate beyond just a fix and flip, was when I realized I could literally take my money. And if I could take 100 grand, get paid 1% a month, that means I'm making $1,000 a month on my money versus 3,000 a year, which is what I was always expecting, right? Apartments. Apartments have been kicked in the teeth the last 2 or 3 years, right? Because interest rates went up too high, too fast, created the biggest stress that apartment owners have ever seen in their lifetime, even worse than 2008, because the interest rates did not do that. In 2008, it did the opposite. They went down, which made it better for buying apartments and whatnot. Well, we saw the opposite happen. So because their interest rates went up so high, so fast, their values came crashing down. So even if they said, "Hey, I got 20% equity in my property," didn't matter when those values came down. We're now at about the bottom of this. I'm not saying it's risk-free again, right? There's still people that are out there. You got to be careful. There's a lot of people that are good actors, but they're not good players, right? They're not necessarily good at doing this. This is why we always vet the people that we bring into our group. We have them talk to our clients because we want to make sure these people actually are legit. Like they've been doing this for decades, not like a couple of years, right? But apartments can be a great one. And I believe in this coming recession, you'll probably see that apartments will make a comeback. You'll start to see some benefit there. Self-storage typically is also recession resistant, although not always, but they tend to be recession resistant because when people go through a recession, they have to downsize. And being Americans, no, they don't know how to throw away their crap. So what do? They throw it into a storage unit, right? So often in recessions, storage units can actually be safer. Now, apartments, self-storage, even like these oil mineral rights and things like that, all these things can be done what's called a syndication, where you pool your money with other investors and you have ownership in those things. So self-storage could be a good option potentially in that. I'll just tell you this though, it may not be today, but often what we tell our clients is, hey, we'll let you know when we start to see the market shift and turn, and then maybe we'll start showing some of those opportunities to you as well, or maybe talk about them a little bit more. But I don't believe that today is that day for self-storage, although it could still be good. Oil, mineral rights. Oil actually now, time wise, is not great because oil prices came crashing on down to like $60 a barrel, and it's very likely oil prices will drop even more. So this is a space I would say is higher risk. You have to be very very careful with. But I mean, I'm in investments like that. I've been paying pretty well. I have clients doing the same thing. But just so you know, now in the timing that we're in, is it the best time or not? That's debatable. And then the last one's partnerships, right? This is where you can partner with other real estate investors in different things. I have a partnership with Raw Land where we buy raw land at wholesale price, flip it at retail, but then we do it on terms where we finance it like a bank does. So then they pay us mortgage payments. And man, it's awesome because not only do we make extra money because we sell it for sometimes double or triple the value, but then we're getting paid interest on that money too, making even more than that amount too. So that's where I've made a lot of money doing that kind of stuff. And there's lots of different ways you can do it too. So again, going back to this big picture, right? To kind of wrap this up is that you got to shift your perspective. You got to realize that there is an alternative, really a world out there that really this is Main Street investing. That's as opposed to Wall Street investing. Wall Street investing has only been around for a few hundred years. Main Street investing, things like you estate, has been around for literally thousands of years. We can even talk about our father Abraham going and getting land, right? And becoming a rich landowner, So again, this is something that's been done for so many years. Yet the thing that's popular based on where there's a lot of money and a lot of people are trying to flood money in and advertise to you, that's why you're always taught you thought it was only one way. You have a choice. And I'll tell you, the alternative choice is way better. Just like I said, we interviewed a guy, one of our clients today. He said, yeah, I had to. He's like, I looked at 8% returns in my 401k. That wasn't enough. He's like, I had to do something else. He's like, I still got money in the market, but I got to do something else as well to do that. And yes, we even talked about doing infinite banking with that too, because again, money flows through and comes back out again to help create this balanced plan that also gives you cash flow. Present planning, not future planning. You actually get benefits today, not waiting till tomorrow. You got other couples that have done the same things. I'm not going to spend a lot of time on this because, I know that we're kind of running short on time. But man, we had this one couple that we didn't just focus on investing, even though they had 5 million in stocks, they want to know what to do with and diversify. The first thing we did was we would look at their cash flow. We said, look, based on your mortgage and everything else, we could refinance, consolidate some of your loans, and actually free up $3,800 a month. Now, some people would be scared of that. They're like, well, you just put that out for 30 years. Yeah. And that 3,800 a month, 45 grand a year, better cash flow, allowing them to be financially free faster and it got their spending down, right? We talked about getting lean. This let them get leaner. We also got them leaner by saving on taxes, over 30,000 a year. So we've already improved their cash flow by 75 grand a year. Then we said, hey, listen, now we got potential here. We got to get liquid. You got a rental here that is making you $0 per month, but you got a couple $100,000 of equity. Let's move that equity over somewhere else and make 2,000 more a month. So they did. So already we got to 100 grand a month with zero out of pocket. We didn't even touch their stocks yet. Then we looked at their stocks, the 5 million stocks. We say, man, even if you only earn 10%, that's another 500,000 a year. Now it's like 600,000 plus, right? Louis, we had him on our podcast before too. He's like this close. He's probably within a year or so away of actually getting to the point where he could actually retire from Hollywood, right? From the industry there. And so he's talking about how he's able to do that. He just bought turnkey rentals. By the way, he only started with $250,000. And with all the rentals he bought, now they're worth almost $700,000 and they're cash flowing almost $4,000 a month. This last guy right here, I'll talk about here really quick, is Dan Markert. He was also on our podcast twice. Dan, I'll tell you, man, that guy, created a ripple effect for us and for me personally. He actually just passed away a few weeks ago, 64 years old, sudden heart attack. It was out of the blue. And by the way, this guy even overcame cancer. Amazing man. And he was looking. He's like, listen, like my financial advisor, I had $1 million in my retirement account. He told me I could live on 30,000 a year. That's not acceptable. So he started looking around. He found podcasts. He eventually found our Money Ripples podcast, started listening to it, reached out. And after he worked with us, said, let's get that money diversified in different places. He bought a couple of duplexes that, again, being managed by somebody else, not him. He also had him get things with apartment syndications, and he did some things with oil and gas. Next thing you know, that 30,000 a year he was expecting was now over 100,000 a year he was earning on that $1 million. What I'm so grateful is that Dan had those years given to him. And imagine if he had just said, you know what, it's just not enough. I got to keep working. And he just kept slaving away, right? Until the day he literally died, right? What if he had done that for the last 4 years and he had just kept working? Instead, he did more cooler projects. He actually worked like for the Forest Service and did some things with them. Obviously he had more time with his family and more freedom to do what he wanted to do. At least for those limited number of years, even though we expect him to live a lot longer, I'm sure he did too. Still, to see the fact that he was able to enjoy his life those last 4 years is everything. You don't know how much time you have. Passive income is what creates that freedom. It's not about, again, recession can be great. You can buy when it's cheap. And by the way, if stock market can be great, you can buy stock market, just wait for it to crash a lot more. Buy when it's cheap. When nobody wants to buy in the stock market, that's usually the best time to buy. That's what I find with anything kind of investments. The best time to buy is when nobody wants to buy it or they don't have the cash to buy it, right? You can take the short path or you take the long path, right? Again, you want to take the most efficient route possible. That's where you can shave off literally years. I wish my dad would be able to do that. He wasn't, right? He didn't. He stayed on that traditional path. He kept slaving and slaving away. Eventually, he was forced into retirement in his 70s due to health reasons. And during those years, he got a few good years. He loved karaoke. He goes by the moniker of Ronnie Cash because he loves Johnny Cash. His name's Ron. He did that, right? He started fishing a lot more. But that only lasted for a few short years, and then health got in the way. And now he's alive, but guys, he's hardly able to really live the life he wanted. What if I could have given back his life too? What if I could have given him an extra 10 years back by steering him the right direction? I didn't. I didn't get that benefit with him. Again, he stayed on that traditional path and literally worked 50 years to then enjoy maybe 10. And now he's within months. He may have months to live. And that's the thing, guys. Like, we never know. Today's not guaranteed. The worst thing you can do is spend your life not doing what you want on the bet you can do it later. When we're in our 20s and 30s, we think we got all the time in the world. I'm in my late 40s, and I'll tell you, we never know. Time's limited, right? The best thing you do is take action now. Cash flow is what creates freedom, and that's something you can actually experience today if you do it right. So next step. Here's what I want to say. Yes, we can definitely send a recording of the webinar for those of you that are already on this list. Next step is, if you want a free consult, you want a conversation, scan the QR code right here. If you can't scan it, there's also the bit.ly link that's there as well. I think we had it. Here it is. Here's the bit.ly link. If you can't scan the QR code, you can see it right there. I know it's a lot of text to be able to do. It's not like a simple like moneyripples.com, but that is our website, of course, if you ever want to look more into us. The thing is, we've been doing this now for, like I said, forever. I mean, I've been doing this even before I started Money Ripples, and I'll tell you that this is what drives me. My dad's story, Dan's story, Roberto, you too, man. Like, you inspired me today with our interview. Like, this is the kind of ripple effect that I want to create with Money Ripples, right? And naturally, I want you to create your own ripple effect. What can you do with that freedom? What kind of things are now possible because now you have more life ahead of you, more things you can do? Is there that philanthropy that you want to start or be involved with? Is there ways that you can actually like really go and serve your family more? Maybe you can enjoy more time with their family while they still have time to enjoy with you, right? Maybe you can do some more things. And, I know a lot of people want to serve like missions and do things like volunteer work, whatever it might be, like whatever it is. Maybe it's start a business. Maybe you do like what I do, because I couldn't retire. I would get bored out of my mind and get depressed. This is what I choose to do. Maybe you got something as well. So anyways, that's the thing that I want for you guys as well. So Roberto, thank you so much. It's always good to listen to these reminders. Janet, like I said, there will be a recording of this webinar. I know you joined late, but that's okay. You've got this. And we'll get you guys this recording if you want it for later as well. But yes, please reach out to us. Love to support you any way possible. I know time's short. I don't have any questions, but again, that consult, that's exactly what it's for. If you're saying, I want to figure out how to start that infinite banking, maybe I don't have like hundreds of thousands of dollars to invest, but I have something, infinite banking might be your path. If you're like, no, I've got cash. What do I do with it? What's possible? Reach out to us and we'll kind of take you down that path and help you do that. Again, I know most people don't take action on things. It's only the smartest and wisest people that do, right? The ones that actually say, I want a better life and I'm willing to do something about it. Just like you, Roberto, you're one of those guys. And as a result, you're seeing results, aren't you? And I know there's many more of you that are. Those are the ones we're calling out. Those are the ones go back to being lulled into security and hoping, riding with those waves of the market. You're gonna be so disappointed. You're gonna be so disappointed, and you're gonna lose out on years of your life unnecessarily. Let's stop that today. So, anyways, guys, thank you for your time. Appreciate it. And of course, yes, thank you to each of you too, and you're welcome. All right, we'll see you later.